Pakistan's regional trade imbalance, anatomy of a structural failure. Introduction: when numbers stop being statistics and become fate. The widening trade deficit between Pakistan and its nine neighboring countries is not a short-term disturbance, nor it is a result of one bad fiscal year, one government or one external shock. It is the visible surface of a deep structural weakness that has hardened over decades. The figure reported for financial year 2026's first quarter, showing a 34.5 year-on-year expansion in the deficit, are not alarming because they are large, because they are predictable. Predictability is the real indictment. When an outcome becomes predictable, it is no longer a crisis, it is a system working exactly as designed. Understanding the number and what the data really says. On paper, the situation looks like this. Trade deficit with nine neighbors: Afghanistan, China, Bangladesh, Sri Lanka, India, Nepal, Bhutan, Maldives. Financial year 2026 from July to September, $3.93 billion, and financial year 2025 at the same period from July to September, it was 2.92 billion. Exports to these countries down by 5.07%, imports from these countries up by 23.95%. This combination, falling exports and rising imports, is the most dangerous configuration any economy can enter. It signals not cyclical imbalance but competitive erosion. An economy can survive high imports if exports rise faster, low imports if imports are contained, low exports if imports are contained. Pakistan is doing neither. The China axis, asymmetry disguised as partnership. The regional trade story is in reality a China story. China accounts for the overwhelming majority of Pakistan's regional imports. 4.86 billion in imports from China in just 3 months against 562 million in exports to China. This produces a trade ratio of roughly 6.5 is to 1 against Pakistan. Why this matters? China is not merely selling consumer goods, it exports machineries, electronics, industrial inputs, capital goods. Pakistan exports low value textile, basic commodities, limited semi processed goods. This is not trade between peers, this is vertical trade. One side supplies complexity, the other side supplies simplicity. In such relationships, the complex producer captures margin, the simple producers absorb volatility, and the deficit becomes permanent. No tariff tweak fixes this, no diplomatic slogans alter it, no industrial capability does. Regional failure beyond China, no secondary engines. A resilient economy doesn't rely on one dominant partner. Pakistan, however, has failed to build secondary regional trade engines. India, trade remains politically frozen, imports collapsed, exports negligible. The result isn't sovereignty, it is low scale. Even minimum trade would have offered diversification and leverage. Pakistan and Sri Lanka, Bangladesh and Sri Lanka. Exports are declining. That signals that Pakistan is losing competitiveness even in markets with similar wage structures and development levels, a devastating indicator. Afghanistan, historically a natural export destination, now declining due to instability, Pakistan's own policy inconsistencies, large trade largely informal, undocumented, and strategically usable. What cannot be recorded cannot be leveraged. The conclusion is harsh but unavoidable. Pakistan has no functioning regional trade ecosystems. The core disease, missing industrial depth. Trade deficits are symptoms. This disease is industrial shallowness. Pakistan imports technology, machinery, chemicals, energy-linked inputs. Pakistan exports labor-intensive goods, low-complexity products, price-sensitive commodities. This longs the economy into low-value trap. Export earnings grow slowly, import bills grow structurally. Currency weakens, inflation flows, debt fills the gap. This is why the country repeatedly turns to institutions like the International Monetary Fund, not because of mismanagement alone, but because of economy cannot guarantee and generate foreign exchange at scale. Why export emergency rhetoric fails. Policy response often revolve around export incentives, subsidies, and emergency declarations. These are cosmetic, not concrete. Exports cannot be commanded into existence. They emerge from industrial clusters, skilled labor, supply chain integration, technological absorption, long-term capital investment. Without this, incentives merely distribute rent among existing exporters who continue selling the same low-value goods to the same limited markets. Strategic implications: trade as power, not accounting. Trade deficits are often discussed as balance sheet issues. In reality, they are power indicators. A country with persistent regional trade deficits has weak bargaining power, cannot influence supply chain, is vulnerable to external shocks, must accept terms set elsewhere. Pakistan's regional position reflects this. China sets terms, markets dictate prices, creditors impose conditions. This is not diplomatic failing, this is economic gravity at work. The harsh truth. And why this will get worse without structural change. If current trends continue, imports will keep rising with population and urbanization. Exports will lag due to stagnant complexity. Deficits will widen. External financing will become more expensive. Strategic autonomy will shrink further. None of this requires pessimism to predict. It is arithmetic. Conclusion: the choice that cannot be avoided. Pakistan's regional trade imbalance is not a temporary crisis to be managed. It is a structural verdict on the country's economic model. Either Pakistan builds industrial depth, moves up value chains, integrates into regional production networks, treats trade as long-term strategy, or it remains an importer of complexity, an exporter of simplicity, or an debtor by design. Nations that cannot sell do not negotiate, they comply. Until this reality is confronted without excuse, every new trade deficit figure will look shocking, while being entirely inevitable.